Money sitting in a savings account earning 0.5% interest while inflation eats away at purchasing power. Sound familiar? This scenario plays out for millions of Americans every single day. Fear of losing money keeps people stuck in financial quicksand, watching their wealth slowly disappear. But here's the truth that changes everything. Not investing is actually the riskiest financial decision anyone can make. Every day spent on the sidelines is a day of lost opportunity, a day when compound growth could have been working its magic. The question isn't whether to invest. The question is where and how to invest in a way that matches personal goals and comfort level. This video will break down everything needed to make that first investment move with confidence. Before putting a single dollar into any investment, there's one crucial step that determines everything else: understanding your investor profile. There are three main investor profiles, and knowing which one fits best will guide every investment decision moving forward. Conservative investors prioritize protecting their money above all else. These are people who lose sleep when their investments drop even a small amount. They prefer steady, predictable returns over the possibility of big gains that come with big risks. Moderate investors sit right in the middle. They want growth, but also want some protection against major losses. These investors can handle some ups and downs in their portfolio as long as the overall trend is upward over time. Aggressive investors are all about growth. They can stomach significant short-term losses because they're focused on long-term wealth building. These investors understand that higher returns require higher risks, and they're comfortable with that trade-off. Here's something that might surprise you. The most important investment decision isn't about stocks or bonds. It's about building an emergency fund before investing anywhere else. An emergency fund is exactly what it sounds like. Money set aside specifically for unexpected expenses, car repairs, medical bills, job loss, or any other financial surprise that life throws your way. Without an emergency fund, any unexpected expense becomes a financial crisis. People end up using credit cards, taking out loans, or worse, pulling money from their investments at the worst possible time. Research shows that people who struggle to recover from financial shocks have less savings to protect against future emergencies. They get stuck in a cycle of debt that becomes harder and harder to escape. But with an emergency fund in place, unexpected expenses become minor inconveniences instead of major disasters. The amount needed in an emergency fund depends on individual circumstances. A good starting point is to think about the most common unexpected expenses from the past and how much they cost. For someone living paycheck to paycheck, even $500 can provide meaningful financial security. For others, 3 to 6 months of living expenses might be the right target. The key is to start somewhere. Even $25 per month adds up over time. The habit of saving is more important than the amount when getting started. The fastest way to build an emergency fund is to make it automatic. Set up a transfer from checking to savings on the same day each month. Treat it like any other bill that must be paid. Keep the emergency fund in a separate savings account that's easy to access, but not so easy that it gets spent on non-emergencies. A high-yield savings account works perfectly for this purpose. Once the emergency fund is in place and the investor profile is clear, it's time to explore actual investment options. The good news is that there are excellent choices for every risk level and every goal. Fixed income investments. Fixed income investments are like lending money and getting paid interest in return. The most common types are bonds, which are essentially IOUs from governments or companies. When you buy a treasury bond, you're lending money to the US government. When you buy a corporate bond, you're lending money to a company. In both cases, they pay you interest for the privilege of using your money. Fixed income investments provide steady, predictable income. They're generally safer than stocks, but offer lower potential returns. They work well for conservative investors or as the stable portion of a moderate portfolio. The easiest way to invest in fixed income is through bond mutual funds or ETFs. These funds own hundreds or thousands of different bonds, providing instant diversification and professional management. Real estate investment trusts. Real estate has always been a popular investment, but buying rental properties requires huge amounts of money and lots of work. Real estate investment trusts solve both problems. REITs are companies that own income-producing real estate like apartment buildings, shopping centers, warehouses, and hotels. When you buy shares in a REIT, you own a piece of all that real estate without having to manage any of it. Here's what makes REITs special. They're required by law to pay out at least 90% of their profits as dividends to shareholders. This means REIT investors get regular income payments, often much higher than what stocks or bonds provide. Stock market investing. Stocks represent ownership in companies. When you buy stock in Apple, you own a tiny piece of Apple. When Apple makes money, you benefit through rising stock prices and potentially dividends. Historically, stocks have provided the highest returns of any major asset class over long periods. The S&P 500, which tracks 500 of the largest U.S. companies, has averaged about 10% annual returns over the past several decades. But stocks come with volatility. Prices go up and down, sometimes dramatically. The key to successful stock investing is time. Over short periods, stocks can lose significant value. Over long periods, they tend to trend upward. For beginners, The easiest way to invest in stocks is through index funds or ETFs. These funds own hundreds or thousands of different stocks, providing instant diversification. Instead of trying to pick individual winners, you own a piece of the entire market. But here's the thing. Smart investors don't put all their money in one type of investment. They diversify across different asset classes to reduce risk while maintaining growth potential. A well-diversified portfolio might include stocks for growth, bonds for stability, and REITs for income and inflation protection. The exact mix depends on the investor's profile and goals. Diversification doesn't guarantee profits or prevent losses, but it does help smooth out the ride. When stocks are down, bonds might be up. When both stocks and bonds struggle, REITs might provide stability. Knowing about investments is one thing. Actually starting is another. Here's how to take that crucial first step from knowledge to action. Step 1. Open an investment account. The first practical step is opening a brokerage account. This is like a bank account, but specifically designed for buying and selling investments. Most major brokerages offer accounts with no minimum balance and no monthly fees. The account opening process is simple and can usually be completed online in just a few minutes. Look for brokerages that offer commission-free trading on stocks and ETFs. This means you won't pay fees every time you buy or sell, which is especially important when starting with smaller amounts. Step 2. Start small and build habits. Don't wait until you have thousands of dollars to start investing. Many brokerages now allow fractional share investing, which means you can buy pieces of expensive stocks with just a few dollars. Set up automatic investments just like the emergency fund. Pick a day each month and have money automatically transferred from your checking account to your investment account. Then have that money automatically invested in your chosen funds. Step 3. Keep it simple. Beginners often make investing more complicated than it needs to be. Start with 1 or 2 broad market index funds or ETFs. These provide instant diversification and professional management at low cost. As knowledge and confidence grow, you can add other investments like REITs or individual stocks. But in the beginning, simple is better. Step 4. Stay the course. The hardest part of investing isn't picking the right investments. It's staying invested when markets get scary. There will be times when investments lose value. There will be news headlines that make you want to sell everything. This is normal and expected. Successful investors understand that market volatility is the price of admission for long-term growth. They stay focused on their goals and keep investing through both good times and bad. Even with the best intentions, new investors often make mistakes that hurt their long-term success. Here are the most common ones and how to avoid them. Trying to time the market. Many people wait for the perfect time to start investing. They want to buy when prices are low and avoid buying when prices are high. The problem is that nobody can consistently predict market movements. Time in the market beats timing the market. Starting early and investing consistently produces better results than trying to jump in and out at the right moments. Putting all money in one investment. Some beginners get excited about a hot stock tip or a trending investment and put all their money in one place. This is extremely risky. Diversification is your friend. Spread investments across different types of assets and different companies or funds. This reduces the impact of any single investment performing poorly. Panicking. During market downturns. Markets go down sometimes. It's not a bug. It's a feature. Downturns are when investments go on sale, not when you should sell everything. The investors who build real wealth are the ones who keep buying during scary times. They understand that temporary declines are part of the process of long-term wealth building. Not starting, because the amount seems small. Some people think they need thousands of dollars to start investing. This keeps them on the sidelines for years while they try to save up a large amount. The truth is that small amounts invested consistently can grow into substantial wealth over time. Thanks to compound growth, even modest investments can become significant over decades. Here's the most powerful concept in all of investing: compound growth. This is when your investment returns start earning their own returns, creating a snowball effect that accelerates over time. Let's look at a real example. Suppose someone invests $200 every month starting at age 25. They earn an average return of 7% per year, which is reasonable for a diversified portfolio. By age 35, after 10 years of investing, they would have contributed $24,000 of their own money, but their account balance would be over $33,000. That extra $9,000 came from compound growth. By age 45, they would have contributed $48,000, but their balance would be over $98,000. By age 55, they would have contributed $72,000, but their balance would be over $210,000. By retirement at age 65, they would have contributed $96,000 of their own money, but their account balance would be over $525,000. That's the power of starting early and letting compound growth work its magic. The key insight is that time is more important than the amount when starting out. Someone who starts investing $100 per month at age 25 will have more money at retirement than someone who starts investing $300 per month at age 35. Here's the truth. Knowledge without action is worthless. Everything covered in this video means nothing unless it leads to actual investment decisions. The perfect investment strategy doesn't exist. The perfect time to start doesn't exist either. What does exist is the opportunity to start building wealth today with whatever amount is available. Remember the 3 key steps. Understand your investor profile, build an emergency fund, then start investing in diversified funds that match your risk tolerance and goals. Don't let analysis paralysis keep you stuck. Start with something simple like a broad market index fund. You can always adjust and add other investments as you learn more. Your future self will thank you for taking action today. The journey to financial freedom starts with a single step, and that step can happen right now. If this video helped clarify where and how to invest, make sure to subscribe to Frankie Finance for more practical money advice. Hit the like button if you found value here, and share this with someone who needs to hear this message. Leave a comment below about your biggest investing question or what's holding you back from getting started. Your financial future is waiting.